Now, we're lucky to begin today's show with one of the best minds in the entire business and investing world. DoubleLine Capital CEO Jeff Gundlach is with us. The Bond King joins us from Buffalo. Jeffrey, I do want to ask you about why you're in Buffalo later in the segment, but let's start with these markets. The equity sell-off is shifted into high gear. Nothing seems to be immune. In fact, now the bigger the company, the more vulnerable the stock. And we know a lot of things are gnawing at this market, right? I mean, what's hitting it the most? Is it liquidity, valuations, inflation, recession, or just something else?
I think it's really the reversal of the linchpin of the market over the past several years, which has been zero interest rates and quantitative easing. And those things are now fading into the rear view. Obviously, the Fed has started to raise interest rates, and quantitative tightening is coming. And that was the combination, the cocktail, if you will, that caused the very quick bear market in late 2018, which the Fed did a monumental pivot to rescue. But the Fed can't do that right now because of all their commitment to the process of trying to bring inflation down. They said it many, many times at the March Fed press conference, did Jay Powell. They're going to bring inflation down. And now here they are raising interest rates. And it's like the Fed, I use an analogy that the Fed is like Mr. Magoo, the old cartoon character, driving his jalopy around. And he can't see very well. He's very nearsighted. And so he drives slowly and then ends up knowing when there's a problem only by bumping into a tree or something. Well, that's what the Fed is doing. Last week, Wednesday, it seems like a long time ago, but it was only 6 trading days ago, Jay Powell said 75 basis points was off the table. And that created a 1,000-point rally in the Dow Jones Industrials because market participants were saying, yay, Mr. Magoo isn't going to jam on the accelerator and go careening around and hit a dumpster somewhere. He's just going to drive twice the speed, which is bad enough, that he was tightening at back in 2018 that caused a bear market. And so for one day, it was, yay, they're not going to drive too fast. But then the next day, it was suddenly like, oh, no, Magoo is still driving his jalopy. He's doing it at a speed that is going to be joined with quantitative tightening.
You know,
so since then,
I'm sorry. I was just going to say I wanted to pick up on your Mr. Magoo analogy, which, by the way, I loved it. Jim Backus, folks, was the voice, and he also played Mr. Thurston Howell III on Gilligan's Island. But what I loved about that show was that, Mr. Magoo always ended up okay. But everyone else around him, you know, like it was the cars that had to move out of his way that got in trouble. And I feel like, to your point, that's what's happening in this market. So the thing is, we have excess money, all the money that came gushing into the system. Initially, it moved these risk assets higher, and then eventually moved goods and prices, services, the prices of those higher. So as we reverse it, I guess to your point, the same is true. Risk assets are taking the brunt of it. And I would assume at some point, too, though, the prices that the Fed wants to see come down, they should come down at some point as well.
They will, although more slowly than anybody would like to see. We've got an inflation model at DoubleLine that's been very hawkish on inflation, not hawkish enough. Nobody expected that we'd get 8.5 year-over-year CPI so quickly. And now we're running at 11% on the PPI today, and we're running export prices and import prices, which I really like to follow because they're more unadulterated than some of the indices that all have all these adjustments to them. And export prices are up 18.8% year over year. Import prices are up 12.5%. And don't think that just because they're export prices, they don't affect Americans, because we also consume many of the goods that we export. So prices will come down, but our model shows that we'll be lucky if we close 2022 at about a 6% CPI level, which is triple what the Fed's looking for and towers over the Treasury interest rates. So since the Fed had that press conference 6 business days ago, we've seen just about everything going down. And we've also started to see, including, interestingly, bond yields, which at the long end have started to come down, even at the belly of the yield curve. And one thing that most investors don't have a magnifying glass that's good enough to see, but we see as bond market investors, is the patterns of risk assets in the bond market have really started to change. It's gotten much more cautionary. Earlier this year, when bond yields on treasuries fell, you actually had good movements, even spread tightening on credit assets like junk bonds. But this time, now that we've had a little bit of a bond rally over the past week, we're seeing just the opposite. We're seeing signs of trouble materializing in the credit market. We're starting, high yield bond spreads have widened by 150 basis points from earlier this year when they were at their tights. We're seeing real carnage in emerging markets, with emerging market bonds down well into the teens and double digits. And just lately, we're starting to see triple C corporate bonds widen out versus double B, higher quality junk bonds, to an extent that investors need to take a look at. And we're also, but with all that happening, Charles, just one last point, we're not seeing disorderly trading. We're seeing less orderly trading, but not the disorderly trading that characterizes a bottom. So we're waiting for that to happen. And of course, we've seen Bitcoin drop 28% in the past 6 trading days. And I've always said Bitcoin is really just the NASDAQ on leverage. NASDAQ's down about 13% over that period. So
on the bond side, to your point, being a bond investor, you understand the mechanisms of this canary in a coal mine. We watch it from a stock market point of view. Bond yields are going down. Why are tech stocks still going down? That kind of thing. And a lot of folks are wondering, particularly folks who watch the show with a 60-40 portfolio, if that 40-year bond rally, if that secular rally is over, and should we be bracing for a secular bear market in bonds?
Well, you had to brace for cyclical bear market in bonds 2 years ago when the long bond closed its losing daily close at exactly 1%. It got to 71 basis points intraday in the teeth of the panic with the lockdown. At this juncture, Charles, we're actually positive on long-term Treasury bonds because of the way the markets are acting. We are seeing signs of recession getting more powerful in Europe with this gas situation in Germany. We saw a very large decline in bond yields in Europe overnight, 16 basis points, 15 to 17 basis points in many of these countries. And right now, the one thing that's working as a hedge is the long-term aspect of the bond market. And I think that we're starting to see real reasons to believe that maybe not here in 2022, but in 2023, we may see a real recession. Because let's think about, Charles, home prices. Home price affordability has decreased very markedly in the past 2 years. Home prices are up 30% broadly in the United States for the past 2 years, and mortgage rates on the 30-year fixed mortgage have doubled. What that means is that the monthly payment for the same house from 2 years ago is now double.
Wow.
We also, you mentioned that things looked pretty good in the aftermath of the money spray in response to the pandemic, but a lot of that was consumption brought forward. One of my favorite charts is to look at the trend of personal consumption expenditures from durables, non-durables, and services. For 5 years or 4 years going into the lockdown prior to the pandemic, all 3 of those series were rising very gradually and consistently and at the same pace. And then when all the money spray happened, we saw this explosion in durables where it got 30% above trend, and we saw an explosion in non-durable consumer spending, 20% now above the trend of that 4-year period of stability and gradual price increases, or rather consumption spending increases. What that means is we have to revert back down to trend. When you buy durables, durable, and that frequently, those accelerate. So when you put together the draw that we're going to have from this spending having been brought forward, now we're paying the price for it, for home price affordability being so bad, and sentiment having collapsed in the University of Michigan survey, right. There's a good reason to believe that we have a payback coming for having plugged the hole back in 2020 and 2021.
So then let me ask you about this commodity super cycle. You were among the very first, if not the first, to even talk about this. According to Eric Norland, to fit this, I want to share with the audience, there are 3 criteria of essentially duration, at least 5 years or longer. It's got to be supersized, so a 300% move at the very least. And of course, it's got to include almost all the commodities out there. Interestingly enough, the CRDB index, it came off of 188 in February 1999, and it climbed almost nonstop to 462 by June 2008, almost a 300% move. Ironically, this leg began at 188. We're at 305. Does this suggest a whole lot more room on the upside for this commodity supercycle, even as the world's economies are beginning to slow?
Yes, because when you think about that, Charles, the movement we've seen since the summer of 2020, that's happened consistent with a stronger dollar. Just imagine what commodity price increases would be in dollars if the dollar hasn't gone up to a new high, basically, over that time period. And also, the commodity cycle tends to last a long time. And there's an excellent chart that Goldman Sachs produced using the Goldman Sachs Commodity Index that goes back many decades, and it compares the total returns of the Goldman Sachs Commodity Index to the total returns of the S&P 500. And it moves very broadly in what have been historically predictable cycles, which last a long time. So what happens is once commodities bottom out versus the S&P 500, commodities tend to outperform over a longer term than I think the fellow you're quoting talked about 300%. It ends up being that the commodities can go up about 800% more than stocks. In other words, it's an 8x return of commodities versus stocks. And then when stocks bottom out versus commodities, it completely reverses, and stocks outperform by about 800%. Well, I don't think I'm going out on a limb by saying that commodities bottomed, which we talked about, in the summer of 2020. And this is with, again, just to reiterate, the dollar going up. Just imagine when the dollar starts to drop, which it will, as we move into the years ahead, thanks to the ridiculous deficit spending in the United States and the ever worsening trade deficit in the United States. When you put those two together, we used to call them, and still do, I guess, the twin deficits. The dollar tends to move in broad swings. With the deficits widening, the dollar goes down. Now, that hasn't happened because of flight to quality and the war in Europe and all those other things, but I think it ultimately will. And when it does, the commodities will continue to outperform. I think investors should have probably 25% minimum of their portfolio in something that's commodity oriented. I don't like gold. We're actually been negative on gold for a while now. Our gold model says that gold is really overvalued versus the movement in real interest rates so far. So I like commodities ex gold.
Would that be a index? Could that just simply be an index instead of trying to pick the right commodity?
Yes. Yeah. You can buy a broad-based commodities. You end up with some gold in there, but it doesn't matter. It's not that big of a weighting. And we look at the BCOM, and there are funds that are just 40 Act mutual funds that transact in commodities. So you can get one-stop shopping there. And I'm not going to recommend any particular fund, but it's pretty easy to screen them.
Let me ask you about crude oil. Since we're talking about commodities, I know it's where this happens to be one of the big drivers, of course, that you had once, at some point, you were looking at $200 a barrel. Is that still possible?
I don't think so. That was really in all the scare of the war coming and everything else. And we got WTI up to 125 a barrel. And as long as the thing is, it doesn't need to go to 150 or 200 to continue to provide tailwinds for inflation. I mean, oil staying where it is today could lead to a 7% CPI for the year 2020 as a whole. We look at the forward curve on West Texas Intermediate crude oil, and it actually suggests that we would have a lower oil price than where we are today later on this year. But if we just stay where we are, about $100, $105 a barrel, we could very well have a 7% CPI for this year. And this is what, going back to how we started the conversation, Charles, that's why there's this Mr. Magoo problem. The Fed is talking about bringing inflation down, and yet there's little reason to believe it's going to go anywhere close to even a 4% level for the year 2022. So they're kind of stuck. They waited too long to raise interest rates. The bond market was way ahead of them. The two-year Treasury is always the leader for what Fed policy is going to be. The two-year Treasury was at 15 basis points about a year ago, and then it went up to almost 275 or so, basically taunting the Fed and begging the Fed to stop with the zero interest rate policy. And the Fed had to do it once the spread between Fed funds and the two-year got so ridiculously wide. And so there's good news that the two-year has relaxed in the past several trading days or couple of weeks, but it still suggests that the Fed has got to raise rates a couple of 50s.
Sure.
And with the bond market trading getting much more illiquid and much more cautious, and the stock market going down in an orderly manner as well, I think we're going to see some disorder and putting in another leg down on risk assets that will be scarier than the one that we experienced in the past couple of weeks, because
so, Jeffrey,
it will be more disorder.
Let me ask you then, because it seems to me, and then yesterday was another example, you're talking about this taunting, where the Fed keeps going out of its way to tell us, no, we're not going to go 75. They had a golden opportunity yesterday after the CPI number and the reaction in the markets, and still we had a couple of Fed heads say, no, we'll stick to 50. What's their reluctance? Everyone expects them to do this. People want them to do this. The market probably would cheer the move. What do you think's holding them back?
It's the Mr. Magoo problem. It's such a blunt instrument that they've got no idea at what level things are going to start falling apart. So they want to do it slowly, but they're so far behind. I understand your point, Charles. They're so far behind that the people. I remember there was some commentator that was saying they should just do, 75 right now, like not even wait for a meeting, just do it. And the market probably, the market probably wouldn't find that to be such a problem, because the bond market is already saying you've got to do this. Mm-hmm. So yeah, they're just very slow, and they want to make sure that they don't just go diving off a cliff or off of a diving board into a swimming pool that has no water. So they're kind of feeling their way along, but they're going to have to do these 50s. And I am surprised that they are so clear in their communication of no 75.
So you're in Buffalo for the Albright Knox Gundlach Art Museum, which, by the way, I looked at the renderings. Absolutely amazing. So tell us about this project, because it certainly looks like a labor of love.
Yeah, the museum was built, the original building was in 1905, and it was completely falling apart. They call it deferred maintenance. I call it neglect. And then there was another building that was built in 1962, and that also has to be upgraded for ADA compliance, everything else. But the most important thing is, the museum is one of the greatest modern art museums in the world, and yet it is very small in terms of its physical plant, and can't show the hundreds of renowned masterpieces that are acknowledged by art enthusiasts around the world. So we decided we needed to upgrade the old buildings and build a lot more space. So we're building a new building that's doubling the size, actually a little more than doubling the size of the prime gallery space. And we started raising the money 6 years ago, and I'm happy to say that the fundraising just in the last month or so has become complete. Oh. And the museum, the new building, and the refurbished campus, it's amazing. We're doubling the size of the gallery space, Charles, and yet we're increasing the amount of green space because we're putting the parking lot underground. So we're actually increasing the green space while increasing the gallery space. We're looking forward to opening, if all goes well, and I think we're on track, in the spring of next year. And so it would be great if the weather on that opening day were like it is today in Buffalo, because it's like a paradise here today.
Well, I got to tell you, I'll definitely make the trek up there. I'm a huge art buff, and I love museums. So we got a couple minutes to go. You see things long before everyone else. Can you guide the audience through a potential roadmap of what's to be expected, perhaps between now and the rest of the year?
Well, I think we're going to have to put in more of a fear low on risk assets, and everything seems to be building in that regard. We're starting to see the high yield bond market is basically shut down. There's been one new issue deal in the past couple of weeks. It's not because companies don't want to borrow money at low interest rates, because the market is getting more and more dicey. So I think we're going to see another 10% drop on the S&P 500 before we hit that risk, that fear low. And that could be consistent with sort of a liquidity problem in the lower tiers of the junk bond market. And that should provide, it'll be scary, but that should provide a buying opportunity. We have gone from our most negative possible on growth stocks to only slightly negative on growth stocks. And we have a look to take, as scary as it's going to be, to get positive, quite positive on growth stocks when we get to that fear low. And I think that low will create a rally that is worth participating in. But I think with the Fed doing its tightening and the quantitative tightening that hasn't even started yet, right, we're probably going to be challenged as we go through this Fed cycle until such time as they are forced to capitulate or they break the inflation cycle. So I think this is going to be a year where 60-40 closes the year with a minus sign in front of it. And I do think, though, that the next 10% down that I'm anticipating on something like the S&P 500 will be joined with, be accompanied by a decline in long-term bond yields. So that's what I'm looking for, although I do think that we have sort of a 2.5% interest rate is going to be hard to get below on most spots of the yield curve.
I got you. Well, it sounds like a little bit more pain, but if we can live through this, maybe we'll come out okay. Jeffrey, fantastic conversation. I really appreciate your time. Thank you so much.
Thanks, Charles.
Appreciate it.